So right now we want to talk about one of the most essential concepts in all of tax preparation, and that is what is the difference between a tax deduction and a tax credit. Before you do your first tax return, we want you to really have a strong understanding of this concept of what is the difference between a tax deduction and a tax credit. Far too many tax preparers, especially beginning tax preparers, really don't understand the difference, and it definitely affects your performance when you don't. And when you do understand the difference, you're going to be a better tax preparer for it. So I'm really excited to finally get to use my whiteboard. Pardon the poor penmanship, but I'm doing my best here. So let's go through right now the difference between a tax deduction and a tax credit. The first thing is going to be tax deduction, okay? So how a tax deduction works, here's an example. You have $20,000 of income, okay? You have a 10% tax rate on that income. In other words, the government is going to take as a tax, as the income tax, 10% of that $20,000 amount. But here you go in with a $10,000 tax deduction. Now this tax deduction is sometimes called, the slang for it is a write-off. And that's a very illustrative term in a way, because essentially what happens when you're using this tax deduction is you take your $20,000 of income, you write off or subtract from that $20,000, $10,000, which is your deduction, okay? That brings you to your taxable income, which is now $10,000, right? $20,000 minus the deduction, minus your write-off. Now, when you have a $10,000 taxable income at a 10% tax rate, your tax is going to be $1,000. And you can see up here, if you did not have that tax write-off, if you were being taxed on the complete amount of your $20,000 of income, what would your tax be? It would be $2,000, right? It'd be 10% of $20,000 instead of 10% of this lower figure. And so that is how tax deductions reduce your actual tax. It's not a direct reduction of tax, but it reduces your taxable income. So that is number one thing to remember about tax deductions, is that tax deductions reduce your taxable income, or reduce the amount of income that is subject to tax. Now, quickly, an important point about tax deductions is that the value of the deduction, right, it depends on the tax rate that is being charged. So, and tax rates will vary, right? We talked about the progressive income tax system, where the more taxable income that you have, your tax rate will go higher. This makes deductions vary in value between one taxpayer and another. So let's say this taxpayer, she's in the 10% tax bracket. However, there could also be a taxpayer that's in the 35% tax bracket. So a very high earning taxpayer. The value of this $10,000 deduction, right, is going to be more for a taxpayer who's in the 35% tax rate than for the 10% tax rate, right? This $10,000 deduction for someone who's in the 35% tax bracket is going to be worth $3,500. But for someone in the 10% tax bracket, it's worth $1,000. So that's another sort of basic concept to realize about tax deductions, is that the value of a tax deduction depends on the rate, the tax rate, the percentage that's being applied to your income. So when you have that write-off, when you have that reduction of taxable income through a deduction, the value of that deduction is based on the tax rate being applied to that income that you are deducting or writing off. So now that you have a strong understanding of what a tax deduction is, let's move over to the other side of the board and let's talk about what is a tax credit and how does that compare to a tax deduction. So as you can see here, we have the number one fact about a tax credit is that a tax credit reduces income tax, the actual tax, dollar for dollar. Now what dollar for dollar means is that for $1 of income tax that you would be paying, if you have a tax credit, $1 of tax credit is going to directly erase $1 of income tax. And you can contrast that with what we saw about tax deductions, where the value of the deduction depends on the rate of tax being applied. Credit, it doesn't matter. Somebody who makes $1 million a year, if they qualify for a tax credit, say a $200 tax credit, is going to receive the same $200 in benefit as somebody who's making $20,000 who qualifies for that same $200 tax credit. Okay, so let's see, this side of the board is a little bit simpler overall, and you can see that once you arrive at this $1,000 tax number, this is an example, simplified example, down here, right, $1,000 of tax, $1,000 of tax here. If you have a $100 tax credit, that $100 is going to directly reduce your income tax in a dollar for dollar fashion. You're now going to be left with $900 of income tax that you owe. Okay, so dollar for dollar tax benefit. And tax credits, because of this dollar for dollar benefit, are more powerful. Okay, overall more powerful than tax deductions, because with tax deduction you're just making a percentage of your deduction. A credit, you're actually making dollar for dollar tax reduction. So bottom line about tax credits reduce actual tax. Tax deduction reduces taxable income, the amount of your income that's being taxed. Tax credit is going to reduce your actual tax. Okay? Very, very important concept to understand. And because tax credits are more powerful, you'll notice that as you're doing taxes, there are very many more rules in a way attached to tax credits. You know, who can claim what tax credit, what makes you eligible. You also can get audited more frequently for an incorrect tax credit than a deduction, just because the value, the tax reduction of the credit is larger. Okay, so there's more tax money at stake in a way. And that's why when working with tax credits, you really have to make sure that the client actually qualifies for the tax credit that you are claiming, because it will be a very powerful tax reduction of a dollar for dollar reduction of tax through the tax credit.